If you've received an inheritance, you may be thinking about ways to make the most of it. Perhaps you want to take a holiday, put the money towards your children's education, or pay off your home loan. You may also want to consider how you could use your inheritance to boost your retirement savings. While you're thinking about your options, putting the funds in a term deposit or high interest savings account may offer a higher interest rate than your everyday bank account. Choosing what's best will depend on the level of debt and income, appetite for risk, and overall financial situation, including how close you are to retirement. So here are some options for you to consider. Pay off your debts. Paying off debts can reduce your financial stress now and in the future. It's wise to pay off loans which charge you the highest interest rates first, such as credit cards, car or personal loans, store cards, and short-term loans. Secondly, build your super balance. Putting money into super can be a tax-effective way to increase your retirement savings. And there are rules around super contributions that you need to be aware of, including contributing an inheritance will generally be counted as a non-concessional after-tax contribution, which means you can contribute up to $180,000 per year, or if you're under age 65 anytime during a financial year, you may be able to bundle 3 years worth of non-concessional contributions into one. This means you could contribute up to $540,000. Excess non-concessional contributions are taxed at 49%. However, you can generally withdraw any excess contributions tax-free, although a deemed earning amount will apply to the excess contributions and will be taxable to you personally. You could also choose to keep the inheritance outside super and set up an arrangement with your employer to contribute more to super from your before-tax income, also known as concessional or salary sacrifice contributions. Concessional contributions don't attract income tax and instead are generally only taxed at 15%. This means you could lower your taxable income. Money you draw from your inheritance could supplement the income you sacrifice. And it's also important to remember that money you put into super is generally not able to be accessed until you retire. And the third point is invest in shares or property outside of super. Depending on how comfortable you are with taking investment risks, you could invest some of your money into assets with the potential to grow in value, like shares or property. Shares and property are two key investment types, sometimes referred to as asset classes. Others include cash and fixed interest. All investment types carry their own risks and benefits, and if you invest in a mix of them, you may be able to minimize the chance that all your investments will perform poorly at the same time. And this is what is known as diversification. It's important to understand the risks involved and seek advice if you're not sure. And some of the things to consider when investing in property. What are some of the benefits of property investment? The rental income you receive may cover your loan repayments. You may be able to claim a tax deduction for some of your expenses, and it can offer a lump sum payment if you decide to sell. So what do you need to consider when investing in property? You will need to pay tax on any income that you make. There are high buying costs including stamp duties, and if you have a variable rate loan and the interest rate goes up, so do your repayments. And you also run the risk that your property may decrease in value. And some of the things to consider when investing in shares. By buying shares, you are buying part ownership of a company. If the company performs well, you can benefit from share price growth. Equally, if the company performs poorly, your share performance will suffer. So what are some of the benefits of shares? They can be bought and sold quickly with relatively low transaction costs. Potential returns from shares include an increase in the share price, also known as capital growth. You may make a capital gain where you sell your shares for more than what you paid for them. Some shares also pay income in the form of dividends, which are distributions paid out of the company's profits to its shareholders. So what do you need to consider when investing in shares? Markets can be volatile, meaning share prices can fluctuate frequently, and this is why shares are considered a higher risk investment. There are brokerage fees. These are what you pay when you buy and sell shares, and you'll need a broker, which can be an online trading platform or a stockbroker. But in any case, please note, any form of investment has its benefits and its risks. A financial advisor can help you decide what your best options are according to your needs and circumstances. So if you want to know more, talk with an Allstar Wealth Advisor today on 1300 788 936. The information in this video is neither professional advice or instruction and is not to be used as such. For specific terms and conditions and rates used in this video, please refer to the PDF download provided. For professional help, please contact John Waters at www.allstarfinance.com.au.